Hello everyone and welcome again to my How To Education channel. As I promised you last week, today we're gonna continue with the second part of the Introduction to Corporate Finance. After watching this video, don't forget to leave me your feedback. As we said last week, even though the division of goals by department is actually very beneficial to the corporation, it can also bring some problems. Another situation that can bring some drawbacks is the separation between owners and managers in a corporation. One of these problems is called the agency problem. To define the agency problem, let's first explain what is an agency relationship. Agency relationship is the relation between the principal and the agent, such that the principal are the owners, which we call shareholders, and the agents are the managers, usually assigned by the shareholders. The agency problem arises from a conflict of interest between the principal and the agent. That is, sometimes the managers of a corporation will act in a certain way that benefits themselves and to the disadvantage of the owners. As for example, an agent who receives commission for a sale might not tell the buyers that the price can be negotiable, thus making the owner potentially lose a client. No matter how dedicated the managers might be, they're not the owners of the corporation and thus have different goals. A manager, for example, needs to keep his job and might end up not choosing a riskier investment to his own interest. Nevertheless, had the investment been chosen, the value of the shares would have exponentially increased to the interest of the owner. Managers might also aim for larger benefits, such as a luxurious car or more power and control over the corporation. To achieve all these needs, a manager might focus on the growth of the company. Even though this seems a very good area to focus on, an unplanned growth might backfire if the management doesn't have the appropriate structure and resources. The value of the shares might therefore decrease instead of increase, affecting the owners negatively. To help reduce the agency problem, some measures can be taken. First of all, shareholders can give a certain incentive or compensation to managers. This way, the interests of managers and shareholders will be aligned. Allowing managers to buy stocks at a lower price and thus acquire some ownership rights might also be a solution. Nevertheless, the benefits must be well structured and caution must be taken so as managers don't receive much control. A proper corporate control, in which the shareholders are active board members and always accompany what's going on in the corporation, can also act as an incentive to decrease this conflict of interest. This is because the firms that are not well managed might be subject to takeovers, thus threatening the manager's employment. The stakeholders are another group of people that can force the firm to take actions for their own interest rather than for the owner's interests. The stakeholders of a corporation are the group of people other than the stockholders and creditors that affect or are affected by its actions and thus can claim the firm's cash somehow. Some examples of stakeholders are directors, employees, government, suppliers, unions, and the community from which the business gets its resources. In order for a corporation to continue to operate properly, thus managing the interests of owners, managers, and stakeholders, it needs cash. This cash will either come from its daily activities or from debt or equity. The money from debt and equity usually comes from the financial markets. That is, a firm needing capital will issue securities, which are usually stocks and bonds. We already defined stocks as being the shares that a creditor receives in exchange for the capital that he puts in the firm. these shares will give the creditor an ownership percentage right over the corporation. In addition, the creditor might receive monthly dividends. Bonds, on the other hand, are certificates that state that the company is borrowing a sum of money, debt, and specify the deadline for the firm to return this money and the percentage of interest that will be paid monthly. After the firm issues these securities, it will sell them to the financial markets in return for the money needed, which will be used to invest in assets that will generate more money coming from the firm's activities. Money coming from the firm's activities is subject to taxation, which goes to the government. What is left after the taxes were deducted will either be used to pay the debt and equity or will be retained in the company. The cash flow coming from the firm's activities must always be higher than the cash flow from the financial markets, which is the borrowed money, so that the firm is successful and does not go bankrupt. The financial markets can operate as primary or as secondary markets. In a primary market, securities are sold for the first time, usually through an initial public offer. The corporation is the one that usually sells these securities to save money for its operations. In a secondary market, the buying and selling of older securities that were previously sold takes place between the dealers, which are the buyers and sellers themselves. This is most common with shares, since a person can buy and sell shares at his or her own discretion and for a countless number of times. Examples of secondary markets include the Nasdaq and the New York Stock Exchange. In the secondary markets, securities may be traded mainly in two different ways. Number 1, through auction market, where a broker who doesn't take part in buying or selling matches a potential buyer with a potential seller and earns a commission, for example in the New York Stock Exchange. Or through a dealer market, where brokers are not involved in the negotiation and the buyers and sellers, who are dealers, assume the full risk. It is not the corporation that issues securities. The already existing securities are traded between the investors themselves, example the Nasdaq. To conclude this chapter, let us just have a quick look on the hierarchy pyramid of the financial management department in a corporation. Within this department, there are 4 main roles: controller, CFO, treasurer, and vice president of finance. The highest rank is held by the CFO, the Chief Financial Officer. Both the controller and the treasurer report to the Vice President of Finance, who in turn reports to the CFO. Treasurers and controllers both have different roles. The controllers usually focus on the inside of the company. They prepare financial statements such as balance sheets, income statements, statement of taxes, and so on, based on past data. Treasurers, on the other hand, focus more on finance and investments for the present and the future, and less on the accounting tasks. This is it from finance for this week. But if you have reached the end of this video, it is because the content is helpful to you somehow. If this is the case, then please do give your friends and acquaintances the opportunity to have access to these videos by liking, sharing, commenting, and subscribing to this channel. We will be continuing with more finance content next Friday. But before that, I will see you all on Monday with some new rules of math derivatives. Thank you so much.